basic logic of investing. The core principle of investing is to make your existing money work for you, allowing it to gain more value over time. Investing means purchasing an asset or financial instrument with the goal of generating more income, capital appreciation, or other benefits in the future. Here are the fundamental points explaining the logic of investing. 1. Money should work, not you. If managed correctly, money can generate income for you. When you don't invest, your money may only cover your expenses or sit idle in a bank account. However, due to inflation, your money can lose its value over time. By investing, you can grow your money, create passive income, and work toward financial independence in the future. 2. Beating inflation. Inflation is a factor that reduces the purchasing power of money over time. For example, a product you can buy today for $100 might cost significantly more in a few years. Investments help protect your money against inflation and can even increase its value. For instance, in an economy with 5% inflation, an investment yielding a 10% return increases the real value of your money. 3. Leveraging time and interest. Compound interest. This is the core mechanism for the growth of investments. The returns you earn are reinvested to generate further earnings. Over time, this cycle creates substantial growth. For example, if you invest $10,000 in an instrument with a 10% annual return, it becomes $11,000 in 1 year. If you reinvest this profit, the second year will yield $12,100. Over time, this growth accelerates significantly. 4. Balancing risk and return. Every investment involves a degree of risk and potential return. Higher returns generally come with higher risks. For example, once low-risk investments, savings accounts, bonds, or fixed deposits provide stable but low returns. High-risk investments, stocks, cryptocurrencies, or venture capital offer higher return potential but also carry greater risk. Choosing investments that align with your risk tolerance and financial goals is essential. 5. Diversification. Another key principle of investing is reducing risks through diversification. Instead of putting all your money into one asset, spreading it across various investments minimizes the impact of poor performance from any single investment. For example, a diversified portfolio combining stocks, bonds, real estate, and foreign currencies is more resilient to market fluctuations. 6. Generating passive income. Investments enable you to earn income without actively working. For instance, stocks can provide dividend income. Real estate offers rental income. Funds and bonds pay regular interest. This passive income offers financial freedom and a more comfortable future. 7. Achieving your financial goals. Investments are a pathway to achieving specific financial goals. For example, short-term goals, vacations, education expenses; medium-term goals, buying a house or a car; long-term goals, saving for retirement. A well-structured investment plan makes these goals more attainable. Conclusion. Summarizing the logic of investing. 1. You make your money work to grow over time. 2. You protect its value against inflation. 3. Small investments, when compounded, can grow into substantial wealth. 4. You manage risks while increasing your earning potential. 5. You generate passive income, achieving financial freedom. To begin investing, you can start with small savings and expand your portfolio as you gain knowledge and experience. The key is patience and maintaining a long-term perspective.